Hello, everybody. It's Helmer coming to you this week with your mortgage market update. It is November 1st, 2023. This week, I am joined with our guest, Nathan Knottingham. Y'all know him from VettaVA. Nathan, please take a minute and introduce yourself.
It's fun to be back on this with you, Hammer. It's been a month now, but we wanted to make sure our VettaVA professionals are with you in this seat, who are dealing with this every day as well. But yeah, I'm Nathan Knottingham, COO, partner with VettaVA, help try to keep this place running the way it's meant to run, and happy to be on. So thanks, brother.
Well, thanks for joining us. Remember, y'all, if you guys have questions or comments, we do want to hear from you. That's what we're here for today, is to answer all of your questions and comments. If you're here live, do us a favor and say hello. Be a part of the conversation, share your thoughts. I'm going to talk about a lot of different events that are going on today and where rates might go over the next couple of weeks. So if you are here, definitely let us know. If you're watching on the replay, though, we also want to hear from you. Do us a favor, just put hashtag replay in the comments. Also, remember, this post is monitored. So if you are watching on the replay and it sparks a question, feel free to go ahead and post that question. You can tag Nathan, myself, or any of the other VettaVA moderators, and we will make sure that we get those questions answered for you and get that done. So with that said, let's go ahead and talk about rates. Remember, this is not an offer to lend, and when we talk about rates, we're talking about averages and generalities. You always want to make sure that you're shopping around and making sure that you are getting the right scenario, the right rate for your situation and thing where you come from. So basically, since last week, we haven't seen much of a change in mortgage rates. Rates have been relatively stable over the last week. Veteran VA rates, mortgage rates generally average in the mid sevens. If you're getting a rate somewhere in those mid sevens, if you're getting quoted, that is an average. So if you're seeing something like that, you can rest assured that you are right in the middle of that average. If for some reason you're not using your VA benefit and you're using what we call conventional mortgages, those through Fannie Mae or Freddie Mac, those are going to generally have a higher interest rate. You're going to find the high sevens would be a very good rate right now if you're not paying a lot of points to get that rate lower, to the mid eights. Generally, if you're finding somewhere in those high sevens to the lower or even the mid eights, that is where mortgage rates are at today. And we'll tell you a little bit about why now. So before I do, though, Nathan, that's usually kind of the update that we give everybody a little bit here. Anything that you'd like to add to that?
Well, I think that one of the things, and we're going to get in the update, and I can't wait to see the Japanese candlesticks, the ups, downs, and overs. But I will say the interest rate dialogue, kind of after we get through the marketplace, what's happening, I want to start talking about the magic of the blended interest rate, the blended rate calculation. So
Okay.
I'm going to pin that, and let's get to it.
And then we'll come back to
after
that.
we get
Awesome.
this. Yep.
All right, so everybody, what Nathan was talking about as far as that fancy chart and graph, and we'll show you guys that here. So today is actually a good day for mortgage rates. If you were quoted a rate yesterday and you go back and ask for a refresh to that rate quote, you may find that your rate is a little bit better today. And that's because the back end of the mortgage market, the mortgage bond market, is actually doing very well today based on some data that came out this morning. We've got a very, very busy week this week on a lot of different economic data. Now, before I explain the charts and the graphs, I didn't get a chance to put it on the slide ahead of time. I apologize, but really just to give everybody a quick update. What's driving mortgage rates right now is the first and foremost is the Fed. Right. So the Fed does not set mortgage rates, but the Fed does control the Fed funds rate, and they influence all kinds of consumer rates. They influence car loan rates, credit card rates, home equity lines of credit, mortgage rates, everything, that's out there, that if there's an interest rate attached to it, if you're borrowing money, it's influenced based on how the Fed has raised rates over the last 18 months. The Fed has raised their Fed funds rate. They've also done what's called quantitative tightening, which means they have reduced their balance sheet, manipulated markets in order to fight inflation. After COVID, inflation was our biggest issue. It was driven up. They thought it would be transitory. That was a term that was thrown around. It proved to be stickier than expected. Everybody knows that right now you spend more at the pump and more at the grocery store than we used to. Almost anything that you were comparing prices to in 2018, 5 years later, 2023, it's a lot more expensive, and that's inflation. So in order to fight inflation, what the Fed does is they're trying to slow the economy down. The way that they do that is through manipulating that Fed funds rate, trying to make it more expensive to borrow money. They're trying to get people to spend less money. Now, unfortunately, or fortunately, how you want to look at it, the economy has continued to chug along very healthy, very strong for the last year, when it was expected to be neck deep in a recession by now. They figured that people would be struggling in their labor market, that the economy would be slowing down, but we are out there spending money and living life, and that has kept the economy out of a recession, and that's why mortgage rates and all the other rates remain high. Now, our forecast is that rates will continue to remain high. We're not going to see them go down anytime soon. The Fed is meeting today. They have a Fed meeting, and then the next meeting will be about 6 weeks from now. And the Fed is not expected to raise that Fed funds rate at this meeting. Each meeting, they can do one of three things. They can lower that Fed funds rate, they can leave the Fed funds rate the same, or they can raise that Fed funds rate. Over the last 18 months, we've seen it go up 11 times. Last month, they did not raise the Fed funds rate. They kept it the same. There was speculation that they may raise it at this meeting. That has since, based on economic and inflationary data, nobody's expecting the Fed to raise the Fed funds rate at this meeting. So now we're going to look at, well, do we think the Fed is going to raise rates in that December meeting? Now, a couple meetings back, the Fed members, they anonymously put out their forecast of where they think the Fed funds rate is going to be at the end of 2023, 2024, 2025, and markets react to that information. And the Fed, a lot of the Fed members, I think it was 12 out of 19 said they expected the Fed funds rate to be a little bit higher than where it is today. So there's one more meeting this year that we could see that rate go up, and that's going to be in the December meeting. It's the middle of December. And what everyone's going to be looking at today, when I say everyone, I mean traders, markets, they're going to be looking for signs of what the Fed has to say in their Fed policy statement today, that even if they don't raise that rate today, is there a door open for raising that rate again in December? Now, if markets think that there is a wide open door and that we may see rates go up higher from here, that's going to hold mortgage rates where they're at, maybe even pressure them a little bit higher. We're going to see a lot of emphasis on Fed Chair Jerome Powell's press conference at 2:30 p.m. Eastern time. And the media is going to ask him a lot of questions about where they think rates are going to be into 2024. Now, if the traders, if markets anticipate that rates are going to stay higher, if that Fed funds rate will stay higher, if the economy is still going to do well, then we're going to see mortgage rates that are, holding where they're at now, maybe getting a little bit higher. If there is a speculation that maybe things will cool off a little bit, we could see mortgage rates improve a little bit from here. Now, today, like I said, if you got a rate quote from the same scenario that you got yesterday, rates are going to be just slightly better today based on how we've seen some of the data come out before the Fed meeting. And there was different labor data. We had what's called job openings and labor turnover survey, where they're looking to see how strong is that jobs market, that labor market. Is there a lot of open jobs? Are people changing jobs? We're going to get another very strong report on Friday. That's called the non-farm payroll. That's the number of new jobs that have been created over the last month. And then also how have wages gone up or down, and what's the employment number look like. And so we could see a lot of rate movement. The rate quotes that you get today, Thursday, Friday, they could definitely vary. We could see what we call volatility in your rate quotes. So if you have that mortgage person that you're talking to and you're, running scenarios and they keep changing the rate on you, they're not playing games. This is because of what's going on in the economy and what's driving mortgage rates on the back end. So that's the emphasis I like to give to everybody as far as where we're going. We should see things settle down a little bit next week. But as far as if you're thinking of buying a home and you're waiting for rates to come down, you don't want to be waiting because rates are not likely to come down significantly. We may see as much as 0.25% or maybe 0.375 your rate improves. That would be a lot right now. And if you were to see that, you should be happy with that. But we're not going to see rates in the 5s or the 6s. That's not going to happen as long as the economy continues to move like it is now. Until we see signs that the economy is slowing down, that the labor market is weakening, that'll force the Fed to then start to roll back some of these pressures that they've put on the economy and raising rates. Once they start lowering rates, probably not going to happen until 4. Now, why would you want to buy a home today instead of waiting till the end of 2024? Well, let's talk about well actually I'll hit that real quick and then we'll go back to that blended rate, because blended rate is more of if you own a home now and you're thinking of doing something. So why would you want to buy a home now? Again, home prices, y'all have noticed, have not collapsed even though mortgage rates have gone higher. The reason for that is inventory. Everybody has a golden handcuff. There's a lot of people that are in their homes with 2 and 3% interest rates that either can't or choose not to move. Somebody that may have started out in a home, maybe they were in a 2-bedroom, 1-bath house, and they said, we're going to start here, but we want to get a bigger house. Now we've got a couple of kids. We need another bathroom. Normally, everybody kind of moves through the market. People move up. We call those move up buyers, buying bigger homes or newer homes or homes in different neighborhoods. And that opens the door, and there's more inventory for more starter home people. Well, that's kind of where we've been locked up. People are not making that move. And because of that, inventory is throttled. And when you don't have a lot of inventory, it's supply and demand. So even though the demand has dropped because of higher rates, supply has also dropped. That's keeping home prices higher. When we do see rates eventually start to come down, what's likely to happen is that the inventory will increase to match that. And it's still going to drive home prices higher. So if you are thinking of buying a home, there's a lot of reasons why you want to be buying a home, and you want to look at the financial implications, but remember that you're always going to be building equity long term. Even if we were to see a retracement in prices long term, it's always a case of equity. When you look, things are built up. And there's the best time to own a home is when you need to own a home is there. But for those, let's talk about blended rates then, Nathan. So I've done a lot of talking. For those people that currently own a home, maybe they've accumulated some debt. What is blended rate? And go ahead, I'll let you talk.
Well, I mean, I really want to hit on what you talked about, supply and demand and that structure. New listings year over year are down. We also just broke another record in August for price valuation increases in our marketplace, even with interest rates where they are. And I agree, blended rate is a good thing if you already own a home. But it's actually a really good thing if you have to sell and are thinking of buying and you're hesitant because you're like, I don't want to lose my 3%, and to go buy again at 7%, right? 100% financing at 7% right now in the marketplace, 7.5 mid-range, whatever it is. Awesome. I'm also going to go back a little bit too and just say, when you were mentioning, and I'm spot on with you. If rates fluctuate, we're not looking at fluctuation. We're looking at minor adjustments here and there, but the time value of money is being calculated into the market on the secondary market. And so you may say, well, Helmer just said rates went down, and you talk to your loan officer like, not really for us, right? There's value there in system. So I just want you to take that with, this is great knowledge, but if you're going to go browbeat your loan officer into getting you a lower rate, they may not have all of that in hand, and it could be like 1/8% difference. So
it would just be a small difference. I agree.
And the cost of the rate's going to be probably a little better. But anyway, so we talked about that. We talked about new listings going in, and I was at a conference a couple weeks ago, and Altos Research with Housing Wire there was a really good descriptor up here, and they were just showing that, like, look, even the summer where we normally see the peaks in the listings, it kind of plateaued. Like, peaks go like this normally, and this year just kind of went, well, maybe not. People weren't moving. So why blended rate? Well, when you're looking at selling a property and you've actually lived in a position where equity lines have gotten, or equity properties have grown pretty well in 2 years, even. Most of your properties will have grown quite a bit in equity based on comparable sales properties in your area. Well, there's two things you can do. If you own your home, you're going to keep your home. Debt consolidation into a HELOC or even a cash out refinance might be a really smart idea when you start thinking about that 20 to 24% credit card debt you have, student loan debt capping 10 to 12%, car debt, depending on your interest rate there. And what you need to do is you start calculating, what are the interest rates I'm paying on this outside debt versus the interest rate I'm paying on my house. And when you put them all together, not only will a payment more often than not be more affordable for all of the debt at 8%, you'll realize that you're saving over time and getting a little bit more of a benefit. Talk to your tax advisor, but now you have interest paid off on a house loan. And there are some benefits to that as well. So there are things to think about. And if you're selling, like, why would I leave 3% to go buy a house at 7%? Well, again, the equity position is better. And so now you're looking at paying off debts that you might have been incurring over the last year or so. We are still spending money, but the cash valuation in our economy is not growing as rapidly. So where's the money coming from? Well, more often than not, it's consumer line debt. And so you're taking on consumer debt for all the right reasons. Maybe you thought you have it paid off very soon. Maybe you thought, like, we're good, we can afford this. And now you're looking at it going, I feel like we're on a tipping point, Hammer. And I'm not an economist, but from what I'm reading, for what I'm seeing, I think we're getting to that point where people are going to be like, yeah, we're done spending money. This is so uncertain where we're going right now and how things are happening. So this could be a good time to look at your assets, look at the valuations of your property, and consider what a blended rate scenario will do to make sure that you're coming back down, making your monthly more affordable, and locking it in. Like, it's time to lock arms and get our finances behind that paywall where they don't leave quite as fast. Make some considerations now before the turn of the year. And I'm really glad you put that up there, Hammer, because consumer debt topped $1 trillion. $1 trillion.
So if somebody, when you say a blended rate, what comes to mind for me is when I look at, well, I have a mortgage rate of, let's just for round numbers, let's say 3%, makes it nice and easy. Mortgage at 3%. And, I have all this other debt, and maybe I have credit cards at 25, 26, 27%, interest rate. What is that blended rate of, if I have $200,000 in home debt at 3%, but I have $50,000 or $30,000 in credit card debt at 26%? How do you come up with that blended rate for somebody?
So I don't do it off the top of my head. I actually have to pull my spreadsheet and use a blended rate calculator, but there are blended rate calculators. And here's what you do. So one super easy one. I've been on drcalculator.com. It's actually I don't know who wrote Dr. Calculator, drcalculator.com, but it is actually really solid. But you basically go in there and you say, okay, here's my current balance, and here's my interest rate on that line of credit. Here's my current balance, and here's that interest rate. Here's my current balance, here's that interest rate. And what it does is it calculates out your balances and your interest rates, your payments, and says, okay, based on everything you have, here's your average interest rate for the balance you have, and tells you here's basically how much you're looking at paying out. And I mean, let me just be super honest. Veta VA and everybody watching, I'm looking, I have an equity position in my home now. I bought it 2 years ago. It's a solid position line. And I'm looking going, I think I'm going to do a home equity line of credit. I'm going to consolidate some of the debt I took out on investments I've done that aren't paying off as well as we thought they would by now, right? There are economic impacts that are not paying off as quickly as we thought or that we had planned for. So I'm going to roll that debt into a home equity line of credit. Will I get that home equity line probably at 8% interest only payment for the first 3 years or so? Yep. But it's a heck of a lot better than what I'm paying from 12 to 20% on those lines. And when I pull all of that into one debt line at 8%, the payment is about a third of what I have to pay right now. So I'm cash flowing my debt line better. And so back in 2007, 2008, remember we're doing those 100% financings at 80/20.
Yeah.
We would do a first at 6.625. That was my personal first. And then my second was 8.75. But your effective rate with calculation was like 7.875, right? It wasn't perfectly split in half, but that was my interest. So calculate and talk to your loan professionals, do some research on blended rates, and understand that your assets, this is how financially wealthy people get more wealthy. They understand the value impact of debt in inflation. It's a guard against inflation, but it's also a way to hedge against recession. And so you get yourself cash oriented right now before things pivot, and then you're better off.
Yeah, no, and that's a great thing. So, and a lot of times too, when we have a low interest rate, people are emotionally married, emotionally invested in that low rate. We don't want to give up that low rate. So when you look at your blended rates, you can decide, and again, also what's out there for you as your unique situation as a consumer, you may be able to get an equity line of credit, or you may need to look at a full cash out refinance. The difference is when you do an equity line of credit, you're keeping that first mortgage, which is in what's called first lien position, that if anyone, when the house gets sold or anything happens, they're the first to get paid. They're the first in line. And then an equity line of credit or an equity loan is usually what's called a second position lien. So they're behind than first. There's more risk because if there's not enough money to go around, they're the first ones to take the haircut. So that's why they generally have a higher interest rate. And a blended rate is if you figure, well, and again, just for round numbers to make it easy for everybody, if I had a $200,000 mortgage, first mortgage at 3%, and I took a $100,000 equity loan at 10%, well, that's basically, I've now got 300,000 in debt. So 2/3 of it is at 3%, but a whole third is at that 10%. If you were to take that and basically just, again, I don't have the blended calculator in my head either, but basically
run that number again. I'm going to tell you right now. I'll just do it right here.
See, before you tell me the number, let's see how close I am at an estimate. So the 200,000 is at 3%. And a 30-year amortization, and the 100,000 at 10%. So that would be 26. So that's 26. Divide that back by your 4 is about. I'm going to say it's about 8 3/4% blended rate.
You know what? It's so much less than that.
What is it?
Consider your payoff structure being the same. It's 5.33% blended rate.
Okay. All right. So see good. So I'm glad that we have the calculator. So because what it's doing is calculating. Okay, well, if you've got this much there, but now compare that if you had that $100,000 instead of being one loan tied to the home, that 10%. Let's say that's credit card debt. That could be 22 to 28% right now.
Say it's 22% on average.
And then
calculate that out.
And then car loans, not only are the interest rate may be similar, but yet the amortization, it's paying off in a few years instead of 30 years. So your cash flow, the amount of money that you're paying out every month is much higher. And if you're looking for a little bit of relief, maybe you're feeling that pinch, and that's why you're falling back on credit card debt, is because there's just more month at the end of your money. I remember being in those situations where there's a little more month at the end of my money. And that might be get you out of that situation, because you are extending the time frame and you're letting your home equity basically pay for that debt for you. You're letting it build that out for you. So they're definitely more complex topics. What would you add, Nathan, as far as how to make these decisions?
Look, the complexity of the topic is it's pretty robust. So number one, educate yourself. Start asking the questions in VetaVA. Ask the questions here. If you're considering what your home is worth, the value of it, plus some of the debt lines you have, start talking about it and asking a trusted individual. If you need a professional, go to vetava.com and talk to one of the loan officers in your state and just say, hey, I've got some questions. I don't think I want to do anything, but I trust VetaVA. I trust you. Talk to me. They will pick up the phone. They will talk to you. That is a guarantee. And if not, again, you can talk to me or Christopher Griffith, and we'll get on the horn and make sure that happens. But the point being, get educated. Start thinking outside of these 8 inches. I had the pleasure of listening to Captain Charlie Plum recently. He's the prisoner of war survivor, 6 years during Vietnam, the pilot, and he did just a great presentation. And it really hit me to hear it again, because the 8 inches right in your cranium, those 8 square inches that you're like, ugh, I'm in my head too much. I can't see past what I don't know. I can't get outside those walls of thought. Sometimes you just need somebody else to talk to, and they're like, oh, what if you just do XYZ? And you're like, thanks for opening the door. Now I can actually see something different, and I can start thinking differently about what I have before I go maybe all super sad and down. There are opportunities and options out there for you to look at. And that's a big part of it. Just have the discussion and be open to learning and start researching. Research blended rate, research interest rates, research payoff calculators, and start working that through. If you go to the VetaVA Go bag on our website, it's non-solicitation. It's not going to hurt you at all. It's not going to actually pull your credit report. It gives you a soft report with a symbol of a score, but it's based on TransUnion, and you can do a whole lot of scenarios. What if I pay this off? How will it affect my score? What if I take this debt but pay all these off? I mean, it runs a scenario base in there for you too. It's right in your hands. It's either on the computer or on your phone, but that's a great tool that you have.
Awesome. Well, thanks, man. I always try to keep these short so that when people are watching, they get a bunch and can run. Is there anything you want to add to it?
It's true. But I will say this, if you're wondering about credit and you haven't seen this yet, we just dropped a massive credit course for all veterans. It's free for you. It's open for you. It was written by our veteran training manager, Shanita Wade. Phenomenal. It's like 5 hours of content. It will take you from I don't know credit to I got to fix my credit to now how do I maintain it? And she goes step by step in all of it. Check that out. If you want to see more, I'll make sure to pin the link here to fill out the form and she'll get you enrolled in the class. You take it at your pace. It's all learning module systems, but it's video based. So any of our veterans out there or corporate people who are like, I hate online training, don't worry. Nita talks to you like this. It's great. It's fantastic.
Awesome. So, well, again, if you have any questions, feel free to tag me, Helmer, in the comments. I'll be glad to answer those. Today, this afternoon, it could get a little bit crazy. So if you are under contract and you're not yet locked in, you can reach out to your loan originator, your mortgage professional, and see what they have to say. And again, that's your best course to get that. But if you're out there home hunting, don't worry. Again, you're not going to see huge moves either way. Get out there and find a home. It's still a great time.
Helmer, publicly, I just want to say thank you for being a great friend for Veta VA and this entire community for doing this so consistently on Wednesdays. You are a gentleman and a scholar, and we appreciate you greatly.
My pleasure. It truly is an honor. I'm glad that I can do it. So thanks, everybody. We'll see you guys next week.